All right. Good evening, everyone. So welcome to our webinar today. So my name is Adam. I'm gonna be your host today. And before we start on this seminar itself, first of all, I'd like to thank everyone that all of you attended this seminar. And if you have any question, do not hesitate to ask the question that we might will and answer later on in this webinar on the Q&A session. So first thing first, we're gonna talk about our company itself. Before we start, I want to make a disclaimer on this webinar today. So the this presentation or this slides has not been reviewed by the Security Commission, and it's not solely provide any general information or financial advice. So we are not liable for any losses arising on this information or that might inclusive in your um, financial decision. So if you have any inquiries or any financial advice, please seek a proper qualified financial advisor or dealer nearest to your branch or your advisor. So, okay, so moving on. So let me introduce our company here, Philip Capital Sdn Bhd. So it's been incorporated in the 7th of October 1995, and it's been a wholly owned subsidiary of Philip Capital Holdings Sdn Bhd. We are formerly known as the Philip Futures Sdn Bhd, and we are one of the trading participants of Bursa Malaysia Derivatives Berhad, and we also participating of the organization of Bursa Malaysia Securities. So we both handle in the futures, CFDs, and as well as in the stock itself. And of course, uh, without the license itself, must be a holder of a capital market service license. So not only restricted to the West Malaysia or the in KL itself, we have multiple branches coming from all the way to All-Star and to JB, as well as in the East Malaysia, Kota Kinabalu, Cebu, and Kuching itself. So I'd like to thank to our clients for being to allow us to become one of the overall best derivatives trading participant and the retail derivatives trading participant, and we are one of the best institutional derivatives trading participant. So not only we restricted in Malaysia itself, we also have multiple global networks throughout the whole world, all the way from the United States and Europe as well as in the Arab countries and across the Asian countries. So what do we offer for our futures stock as well? We do for futures we do have the ICE or the Intercontinental Exchange, as well as the European Exchange, as well as the CME, the CBOT, the CBOE, and COMEX, and YMX, and ECBOT and YFOX, and as well as in the stocks that we have the New York Stock Exchange, the Nasdaq Stock Exchange, as well as the AMEX, the American Stock Exchange. Now, we're not only restricted to that, we have also in the Tokyo market, the Tokyo and the Osaka Exchange, as well as the from Hong Kong Future Exchange, as well as the Hong Kong Stock Exchange. We do offer the Australian stock as well. So do not hesitate if you really want to invest in the Australian stock market. You can always approach one of our dealers to your nearest branch. So we provide everything to our clients. Uh, we also have futures, like I mentioned, equities, as well as CFDs. Now we have index futures, agriculture futures, metal futures, energy futures. Lastly, the interest rate futures. For equities, as I mentioned in previous slides, as well as the Hong Kong shares, Singapore shares, and Australia shares. Same goes to our CFDs, one of our products. Now, why Philip? So we are one of the well-known in throughout the Malaysia and globally as well. We won award-winning multi-asset broker, and we also provide a technical support 24 hours, and we have also a customized service to our clients. and we also provide the latest market updates. So our services, we do have provide free coaching one-to-one. If you have any, if you're a beginner or intermediate, you can always approach to our dealer if you have need more knowledge, external knowledge, or you need to upgrade your skills. So if you visit to our website, we have also provide a market views and market update every Monday, 11 a.m. provided by our analysts from Singapore, the Philips Securities Research. So they like counter technical analysis and every Monday on the night of 8 p.m. So if you have any interested of our upcoming seminar webinar, please do scan this QR. I give 10 seconds to you to scan this QR. All right, so I believe everyone got it. Let's move on to our next. And this is our online account opening forms. We're currently going to be a digitalized company. Uh, so if you are interested to open accounts, you can always scan the QR. I'll give another 10 seconds for this. Right. Is everyone good? So I'll just proceed to the next slides. And let me introduce one of our futures platform, which is our latest Philip Nova. Currently, we are integrated with the trading view. So as you can see in this slides that Philip Nova has been integrated with trading view. You can also access through the trading panel of the trading view if you're using trading view fully. And this is one of our stock platforms, which is the Poems Global, the 3.0 for the mobile version and the 2.0 for the desktop version. Also been integrated with the trading view itself through the Poems Global Mobile 3.0. And this is our CFD platform, quite user friendly and very accessible to some of our beginner clients and sophisticated clients. Now, for our ongoing promotions, you can participate this by scanning through our QR for if you are interested and to see more of it. Of course, this promotion must be only be the Bursa market derivatives such as the KLCI, FKLI, and the FCP or the gold futures and the mini USD and CNH futures. And next up, our latest product through CME, COMEX, my apologies, is the 1 ounce gold trading. This is very accessible to those who is just begin futures trading, and the initial margin is quite very low, and the same goes to the brokerage as well. So this will be final chance to participate will be only until 15th of April 2025. And scan the QR for more info. All right, next up, our last promotion here. We do now offer the multiple index, Asia index, such as the Singapore index, the Vietnam index, the China A50 and H50 index, the Taiwan index, Japan index, and lastly, the Indonesian index is under the FTSE and the MSCI. You can trade as low as $1.88. Scan the QR code if you need to know more further. All right, so before we proceed to the main seminar today, let me introduce our speaker. Today is David Ng, will be our speaker for this seminar. So David Ng is actually currently a full-time prop trader with the iceberg cigar Bahad, a local proprietary trader trading firm based in Kuala Lumpur. Has done a lot of extensive research and well-versed in commodities and indices markets as well. He currently trades at the Malaysia Index and the crude palm oil actively. Currently, he holds the CMT vaccination as a chartered market technician. A very well experienced guy. And previously, he led the young and dynamic team with a prominent local broker to promote futures and derivatives instrument to the Malaysian public. And he regularly conducts some public seminars on topics related to futures trading, as well as have helped many individuals on how to the trading journey. And in addition, he also provides frequent market commentaries to local media such as the Stars, Business Times, and the Edge in that role. So this welcome, Mr. David. On to you, Mr. David.
Yeah, thank you, Adam. Just going to share my slides now. Just let me know if you can see my screen. It should be okay. Adam, can you see my slides? Adam?
No, hold on, I can't see your slides yet. No,
Okay, let me just try to do it again.
yeah,
Screen. Okay, how about now?
yep. Now I can see it. All right, on to you, Mr. David.
Okay,
Floor is
thank
yours.
you, Adam. Yep. Yeah. Thank you everyone for joining us tonight. Firstly, just before I start, just like to thank Philip Capital as well as the exchange Bursar for inviting me to speak on today's topic. I know gold is a very interesting topic, especially with all the ongoing market volatility that we're seeing and witnessing right now. So the key question that we try to answer, or I will try to answer, is gold is definitely on all-time high levels. Can the prices continue to last and even ride higher? Uh, Obviously, there's a couple of factors to look at it, and I think we're going to delve into some of the key factors that actually support gold prices in general. But I think what's important is that if you're trading a gold market, or regardless any market as of now, I think markets are very volatile. So if you are trading it, you really have to make sure that you have a existing plan that able to withstand, or make sure you have a way to get yourself out in case the market goes against you, because I think markets are truly volatile. Obviously there's opportunity, but also there's more risk management involved. So make sure you have those plans in place. So just before I begin, I just like to reiterate what Adam has mentioned earlier. So this presentation is purely for educational purpose. Is purely any comments that's coming from me is purely my own personal comment. Doesn't reflect opinions from whether it's from Philip Capital or from the exchange. And dealing with derivatives, especially futures market, requires knowledge. So make sure you have sufficient knowledge. I believe in this regard, Philip Capital can help you to assist you if you are new to the futures trading. Hopefully, they are able to assist you in embarking on this journey. Um, yeah, so in the next half an hour for 5 minutes or so, I think what this section is going to entail is that probably looking into factors that actually drive gold prices. Now personally, I believe that these factors will continue to drive gold prices even higher. Now obviously the market so volatile these days, and equities market are in the whole or bearish momentum, as what we're seeing, the fear in the market. Normally gold prices will tend to do well, and then we've seen the performance of gold. And I think these are the key factors that's really going to drive gold prices in the next couple of days or even weeks or so. So this Trump trade tariff threats are beginning to unfold, and I think trade wars are definitely happening, and it's creating a lot of chaos in pretty much across the markets. Now, in times of uncertainty, definitely I think gold is an ultimate beneficiary in terms of asset classes. So do look out if you are trading gold. I think it's interesting times. But I mentioned, markets and prices are very volatile, so make sure you have a plan in place to get yourself out just in case when things go wrong. So I'm a trader that use trend trading techniques, mainly looking at trend trading tools like Heiken Ashi candles and DMI trend indicator, which is commonly used if you're looking at strength of a trend. I'm just going to share with this in a deeper way, in the deeper manner in the second part of this webinar. So hopefully you can gain a bit of understanding on how to navigate, especially the gold market during this period of time. Now, having said that, gold prices has almost inched close to 3,200 US dollar per ounce. That's pretty much all time high. And I think just about an hour ago, I think China just came out on a news wire that they're going to retaliate in terms of the tariff on US goods. So that will bring that the total China tariff on US goods will be about 118. That's pretty high and very significant. Now, this is very damaging to the economy, regardless whether it's for US or for China. When you have such a high tariff imposed, it's not looking good. It's definitely going to be demand destruction along the line. So let's see. I think in the next couple of days is very crucial to see how markets react. Now, having said that, gold has actually reacted quite positively with this news. Obviously, with tariff threats, and with trade wars happening, there's a lot of uncertainty in the market, and as a result there's a lot of plight to safety, and I think in that sense gold as a safe haven asset remains very relevant. So like I mentioned, I think is crucial point right now, with all the tariff threats that's happening, is gold is definitely taking a lot of positive impact out of this uncertainty in the market. Now, you can clearly see, I think, late last year, if you just compare the performance of gold and equity space, especially in US equities, you can see that actually both are quite in line. Now, obviously, when Trump came into the picture, when Trump won the second time round, Trump 2.0 ushered in more volatility, and therefore, I think equities market took a tumble. But the on the good side is that if you are looking at gold market itself, gold is actually climbing to all-time high prices because of that. Now, I think the trend is quite the strong uptrend in gold prices is going to stay persistent because US equities markets are still not performing, and as long as the tariff threats are still remain very imminent, and there's no negotiation, or there's no sign of letting go in terms of any negotiation room, it is definitely going to bring a lot of pressure for equity space, and therefore that eventually will just benefit gold prices. So I think that's the ultimate positive force that really can support gold prices in the medium term. Now, in terms of market volatility, if you just look at VIX as a barometer of fear or market fear, you can see that we are almost reaching the levels during the height of the pandemic. So it goes to shows that we are in a very volatile and uncertain period, and therefore during this time usually gold tends to benefit. Now, if you are in any other asset classes, obviously we've seen how the past couple of days actions is you can really see investors are slowly moving assets, whether it's from the equities or the bond space, right into whether it's on gold or even into cash holding. So it's crucial. I think when markets are uncertain, people will put more risk off, and I think as a result, gold is one of the major beneficiary, and also obviously people tend to hold more cash, just to wait off and to see what happens next. So this is the period that we are looking at, and this is a period where we are right now. Now, if you look at gold in terms of performance-wise over the past decades, whether you're talking about a decade or 2 decades ago, if you compare with other asset classes, I think generally gold performed relatively quite well. Now, having said that, I think therefore it illustrates the point that gold as an asset, it holds value in the longer run. So there's a lot of positive factors that actually drive the demand for gold. Obviously, with market uncertainty is one major factor, and the other second factor to look at gold in terms of holding asset value is actually quite prominent. So over the years, despite equities market has been very volatile, you still see that gold generally is still performing, or still holding its value relatively well compared to other asset classes. So I think that therefore you can see there's a trend ongoing for the past couple of years that a lot of portfolio managers are slowly moving their asset classes away from equities, away from fixed income instruments into gold as a alternative or diversifier asset class. Now, here are some of the lists of factors that affects gold prices in general. Demand and supplies are crucial. Now, supply for golds are actually very fixed. You don't see a year there's a sudden surge in supply of gold because there's always a fixed amount of mined and unmined gold reserve on ground and under the ground. So supply of gold is actually pretty fixed, but the demand is what drives gold prices in general. So when you have huge demand, or whether there's a lack of demand, normally that will bring prices that will influence prices. Now, economic climate is a major one. So with now economy being very uncertain, trade war is happening across the world, especially instigated by the U.S. Tariff threats. So really, I think economic climate is getting very pessimistic, and therefore is actually propelling gold prices even higher. Dollar strength is another factor. Dollar and gold is always an inverse issue. When you have a stronger dollar, normally you expect gold prices to come down. So dollar strength really relates to how the U.S. economy is going to perform. As long as now with U.S. Introducing tariff threats, the dollar strength ultimately will lose its prominence, and therefore eventually that will benefit gold prices with a weaker dollar. Interest rate is another factor. Keep in mind, gold is a non-interest bearing asset. It doesn't pay you interest, unlike if you hold equities or fixed asset instruments. So obviously, with low interest rate environment is better for gold, or it creates a higher demand for gold because opportunity cost is much lower. Now, if with high interest rate environment, normally you don't favor gold because you can obviously park your assets with other asset classes that pay higher interest. So when you have high interest rate environment, normally you don't see high gold prices, but vice versa, you see low interest rate environment, that will push gold prices higher. Inflation is another one. Inflation, if you see persistent high inflation, people will obviously rush into gold because there's a store of value. They reflect gold as an asset that stores its value. So high inflation period usually denotes there's a demand for gold, just because of the status of gold as a as an asset that holds its value. So high inflation relates to higher gold prices. And last but not least, geopolitical risk. This is very is unpredictable, very uncertain. Despite we are seeing now as a lot of economic uncertainty, geopolitical risk is still quite imminent. We have the Middle East tension, we have Ukraine and Russia that's still ongoing. So geopolitical risk is still quite persistent, and that's some of the key factors that actually drive gold prices into higher levels. Now, if you just look at it, gold generally, if the market moves like what we're seeing in the last couple of days, where I think they almost gave up 15% from the all-time high levels, especially for the U.S. equities. Normally, you see gold tend to perform very well. It's the role of gold as I would say, is a risk-off asset where if you want to if managers or portfolio managers are rushing for safety, gold is one of the key assets to look at. So really, I think markets are now moving into bearish territory, and I think that's what's keeping gold prices, or that's what's keeping the bullish momentum in gold prices. Now, here you can see, I think VIX index are climbing. Now it's easily above 40. I think with this latest salvo from China doing the retaliatory tariff on US goods, that will even push VIX even to higher levels. So when VIX are on high levels above anything that's above 20 or 25, it does indicate that to you there's fear in the market. And when there's fear in the market, people usually rush into gold as well. We've seen that during the pandemic, when VIX hit as high as 80 to 100 index points. There was generally a very fearful market, and therefore I think gold benefited in that sense. Now, besides that, economic climate is an important factor. Now everyone is talking about recession in place. If Trump is continually persistent on insisting on the tariff threats, generally you're going to see demand to soften. Goods is definitely going to be prices of goods definitely going to be elevated, and I think that will create a lot of tension, economic tension. So recession fears are back, and this time is growing worry. You can see a lot of people, some of the major banks are forecasting that probably US going to hit a recession, a very bad recession by the second half of this year. So I think fear in the market is very evident, and I think recession is what is being talked in town. And normally in this type of regards, there's always a need for people generally to look at a safe haven asset, and in this sense, gold is something that people look at. Now, despite that, beside gold, they also look at bonds as a way to to safeguard their investments. But generally, I think you look at pressure on U.S. Treasury yields, you can clearly see that there's a lot of selling when it comes to U.S. government bonds. I think therefore that explains why the yield has actually been inching higher the past couple of days. Now that's whether is it a positioning by other major central countries that hold it or that's holding a lot of U.S. Treasury, or rather this is also a plight of safety where people are just going into different asset classes to safeguard their investments. But having said that, I think when you have a yield environment that's actually inching higher, generally that doesn't do well for the economy on the longer run. So recession fears are very elevated, and I think consumer sentiments are also taking a toll. So U.S. economy runs on a very strong consumer confidence. If consumers are not confident enough to spend, I think that generally be a drag on the overall economy. So global asset volatility is you can see is rising. You can see there's a sudden surge in daily price range. You just look at S&P or even Dow Jones, for example. Last couple of days, in fact, I think the daily range has I think it was almost reached the pandemic levels where daily range is spanned across more than 1,000 index points on a single day range. That's quite huge. So it goes to show that actually markets are embracing more volatility. When it comes to fear index, I think market now is extremely fearful, and I think as that's they're just waiting for more clarity in terms of the impact for the trade tariff. But as long as negotiations are not underway, there's no sign of negotiations that's underway. Markets are still quite fearful in general. Now, if you look at it in terms of period of high inflation, the reason why a lot of people are expecting that inflation particularly in US is going to inch higher going forward. Despite that demand is going to be softened because of rising prices. Now we have threats of tariff that is kicking in, and that will make goods in general, if they are importing from other countries, to be priced higher, and therefore that generally will create a lot of inflationary environment. But it's still early to tell. Now, this will give a lot of pressure for Federal Reserve. And as long as inflation is not within control, I think Federal Reserve will probably be not comfortable enough. So generally, if you have a high inflation environment, gold tends to do well. So we are faced with a scenario or a situation whereby we have an inflation concern that's coming, and if it's not contained well, generally that will be a spike in inflation numbers, and that's a concern generally for Federal Reserve. And that brings to a question where in this type of environment, gold, in high inflation environment, gold tend to be favored as a result. Now, if you just look at comparing gold prices and the money growth, you can clearly see there's a positive trend. As long as there's more circulation of money growth in the economy, that usually spells high inflation, and that means there's also higher gold prices in this sense. So, this is going back to the point where gold as as an asset that safeguard against inflation remains very quite evident and proper. Now, when it comes to rate cuts, now this gets interesting. In the beginning of the year, before Trump came in, I think market was expecting that US probably may go for two rate cuts at best throughout the year. I think things has changed. In fact, the view has changed. In fact, now people are expecting the Federal Reserve or hoping the Federal Reserve will probably be getting more rate cuts along the way. If the economy indicators are pointing to you that the economy is not on a strong footing, especially the inflation numbers and employment numbers are very key. So as long as these two numbers are heading down south, I think Federal Reserve will just have to react, and just by cutting more, by putting more rate cuts expectation. So I think markets are expecting, with this current onslaught that we're seeing in the market space, people are just looking at about 5 rate cuts for the year. Now things can change. Really, it all depends on how the trade tariff is being influenced in the overall market in general. Now, if you just look at gold prices and interest rate environment, you can see that generally when you have low interest rate environment, it's usually benefit gold prices. As I mentioned earlier, gold as an asset class doesn't give you any interest. It doesn't pay you interest. You hold gold is just for the value. So interesting enough, if you have a high interest rate environment, generally you don't tend to favor gold prices because when it's high interest rate environment, there's always other asset classes that pays better interest. So generally, when you have low interest rate environment, that's where gold tend to be favored. So in current scenario, if you're expecting further rate cuts from US Federal Reserve going forward, we should see this as a positive factor that support gold prices in general. Keeping in mind, lower interest rates would normally propel gold prices or support gold prices because there's a demand for gold, given that there's lower opportunity cost right now. Now, dollar and gold relationship is always inverse. At most time, it's inverse. So you can clearly see the stronger dollar generally doesn't very benefit gold prices because gold is usually or ultimately priced in US dollar. So when you have a stronger dollar, it looks gold is actually more expensive compared relatively to other currencies. So when you have a weaker dollar, then that's a different story. Then usually the inverse happens. Weaker dollar usually entails stronger demand for gold. Now, dollar strength is very depending on how the trade war is going to play out. Now, obviously, with trade war starting to kick in, the you can see weakening dollar. If you compare to other major currencies as well, dollar doesn't depreciate as much. But no, in general, you can see there's a weakness in terms of the dollar strength itself, and that generally boils well with gold prices. So watch out. I think if you expect dollar to remain weaker throughout the period, especially during this time, generally that will be also another positive factor that support gold prices in general. Now, talking about the threat of the US dollar, it's interesting enough. A lot of people say that the position of US dollar in terms of global currency is slowly losing its prominence. For the simple fact that if you compare decades ago, generally US dollar is hold or rather majority of the central banks across the world prefer to hold a US dollar. But I think that can change. Political dynamics are changing, ever changing. The landscapes are ever changing. Then countries are forming ties and alliance. So I think that really question, the role of the US dollar prominence in the global system. But having said that, I think it's a very in order to totally replace the US dollar is a remarkable feat. I don't think you can see that in the near term. But I think the role of the US dollar in terms of global payment or global system or global reserve system is actually slowly losing its prominence. And with this trade war that's actually happening, it will actually probably aggravate that kind of situation further. So US dollar in a sense is still important, but I think the relative importance are slowly diminishing along the way. Now, overall demand for gold over the past couple of months has actually been very strong. Now, if you break down gold into specific demand, whether it's mainly into jewelry or whether it's talk about investment demand and central banks, you can see that there's a strong demand across the board, coming from jewelry, coming from investments, and coming from central banks. Now, this is quite surprising. So, generally, when you have high gold prices, you don't expect jewelry demand to pick up because consumers are very sensitive. If you see price at all-time high, normally they'll consumers will back down. They see which one, they'll probably will see which level to probably go in. They'll probably wait for gold to be traced. So it's surprising to see that even you see gold prices at all-time high, you still see consumers are still buying jewelry as a result. But I think the biggest demand support for gold is actually coming from central banks. Central banks has been aggressively buying since the later part of 2022, and then we can see that trend is still continuing to do persistently very well. So it goes to show, I think central banks, whether it's positioning their assets, moving away from paper money into diversifying into gold, that potentially could be a reason. But I think as long as central banks buying has been strong, I think this is what will keep gold prices high. But as long as central banks starts to slow down their purchase of gold, that may have an impact in terms of overall demand for gold. So watch out in the next couple of months or so when prices are at all-time high. Obviously now with the extra market uncertainty, that will probably be something that's what making central banks fearful and still buying into gold. But eventually, I think when prices are at a specific level where they think is a bit too high for them to purchase, probably they'll slow down their purchases. And I think that's where market or whether prices may face correction. So watch out on central bank buying. I think that's a key factor to watch out when it comes to demand. Now, investment flow for gold is actually very strong. You can see in the month of January and February, we see strong inflows into the ETF space. So it goes to show, I think January, uh, with market uncertainty and with gold prices hitting all-time high, I think people is just trying to, trying to gain, or rather, the all-time high price is trying to uh, evoke interest among the investment fraternity, and therefore I think that created a lot of interest, buying interest from the investment public. So that explains why the inflows have actually been very strong despite we are seeing all-time high prices. Now, if you recall, I think early part of February we saw there's a bit of physical dislocation in terms of prices between COMEX, the US gold prices, and obviously the London spot gold prices. Normally, this don't happen. Usually the London spot will probably be trading at a probably be a range premium compared to the US gold market. So that has changed. I think that is in anticipation of the tariff to kick in. A lot of physical movement that's actually coming in into the market space, and that caused a bit of dislocation in terms of pricing. But I think that eventually the price dislocation has actually been set. I think it's actually going back to normal. But this goes to show there's a lot of interest in the spot market. A lot of people are actually demanding gold as a result, and that actually push prices higher. So you are not only having, demand from investment, but also have strong physical demand. People who just want to have gold in general. So this is what this you just look at this chart. There's a bit of physical dislocation in the early part of February, but I think that has actually been softened. But it goes to show the spot market for gold is actually still quite strong. It shows to you that the demand, despite gold at all-time high prices, the demand for gold in the spot market is still pretty strong. Now, if you just look at the breakdown in terms of countries, you can see that Asia tend to have the largest increase in terms of their demand for gold, and this is mainly coming from China. And central bank in China has been aggressively buying gold since the later part of 2022. Whether this is a position for them to diversify away from other asset classes as part of their reserve currency or reserve status, that I'm not really sure. But I think as long as they favor gold in general, I think that's something to watch. So China is a very major element when it comes to demand for gold. So the key question is that with prices at all-time high, will China continue to purchase? I would say that probably when prices at this level, they may actually soften in terms of their demand. But having said that, because the market is getting uncertain, they be shifting some of the assets away from US asset base, especially the US Treasury, and moving into the gold market. So really, I think China central bank has actually been very aggressive when it comes to buying gold. That whether that can sustain is still a question, but from the numbers we have seen so far, it is really showing that China is still very persistent. But watch out when prices are actually going higher and higher. That will probably be making China a bit more sensitive when it comes to buying gold. And when China starts to slow down, that will probably be something that will soften the market. So that's something very key to watch out, especially for the next couple of months. So Chinese gold, really, I think the China factor when it comes to buying gold has actually been very prominent, and I think that's created a lot of interest in the gold market. And I think mainly it's because China central banks is slowly moving or slowly diversifying away from other asset classes and into the gold market. So this is what I meant. This is if you just look at the numbers itself, China gold buying has actually been very persistent and very consistent. But it comes to a point where if prices are reaching all-time high levels, they probably will start to slow down because prices at all-time high levels that will create a bit more demand destruction. So do watch out, and it's important to watch whether China will continue to purchase more when prices are actually when gold price at all-time high. Now, there's a couple of reasons. I think one of the key reasons that I think they look at China central bank look at gold as another way to diversify their assets. Another key factor is that I think China economy is actually still not doing so well. Property crisis it's not a short term thing it's not a short term problem where it can just resolve in a matter of months. It's a very long term structural issue with the economy. So property crisis in China is still ongoing despite there's a lot of stimulus measure that's announced by the government. But I think property crisis it still remains a major hindrance. So as long as the economy is not showing you sign of going out of this issue, China economy is going to be a major drag, and that prompted central banks probably would change its stance and move into the gold as a way to safeguard its asset. Now, Chinese consumers are also feeling the pinch because of the property crisis. They've actually been less optimistic with with their spending, also with their own economy. So as long as consumers are not feeling confident, again, this is going to be a major drag for the China economy. Now, this explains why, despite the strong demand coming from central bank, the consumer demand has actually been softening. Reason being is because, like I mentioned, consumers are very price sensitive. When prices are all-time high, generally that will slow down the purchases, will slow down consumer purchases. You can clearly see, I think, despite economy is also not doing well, you can see consumer demand in for jewelry in China is actually slowing down as well. So it's very a price issue. Now, as long as price remains where it is, consumer will probably stay back or hold back their purchases, until where they think the price should be, and they will start buying again. But it's a different story for central banks. Central banks, they'll just buy, just to reposition their assets into gold, regardless of the price level. But eventually, once they will hit a peak point, and they will tend to slow down as well. So that's pretty much on demand. I just want to touch a little bit on supply, or rather in regards to production cost for producing gold. If you just look at, this is a chart where it shows the all-in supply cost for producing gold. You can see that's rising over the years. I think if you look at early part of 2010, the cost of producing one trade ounce of gold is probably about 700 to 800 US dollar. Right now, it's almost approaching about 1,003 or 1,004. It's still a pretty good margin for a lot of gold miners. But then again, the rising cost of production is going to be a concern. If there's any correction in the gold market, this is pretty much the floor level that the gold price can eventually reach. But eventually, I think with cost of production that's going higher and higher year by year, is in a way that's putting a floor price that's going higher by higher year on year, uh, for the gold market in general. Now, what's interesting is that, if you just look at, if you're trading gold for quite some time, if you're trading gold futures on a weekly basis, we have an open, we call it a CFTC report, which details to you the open positions in the market. So, generally, when you have a strong market like this, you should expect that the open interest positions to start rising. Because generally, if people are expecting the bull market in gold to at least extend its rally, people will hold positions or long positions in the market. Now, when you have a strong bull market but the open positions are declining, that's a concern, because generally that tells you that people are expecting that, every time when the price hit a new level, people are just coming off the market. They are not, they are exiting their long positions, and that generally is not a healthy uptrend, or that's generally not a healthy bull market. So in the past couple of weeks, we have seen that, net long position has actually been declining, especially when markets are at all-time high. Or I think only in recent, just last week and last week and the last 2 weeks ago, we see that the net interest position actually been increasing. So that's pretty in line with what the market consensus is. As long as net interest positions, net positive interest positions are still rising, especially in a bull market, is still is still a healthy trend in the market. So watch out whenever the net positions are starting to peak, and especially when positions are peak, and markets are all-time high, it generally tells you that probably going to be peaking prices as well. So watch out. I think net interest positions will tell you a lot whether how the sentiment of the market is. Are the market participants still expecting the markets still continue to be bullish, or expecting the markets to retrace in time to come? So watch out. Interest positions are something to be monitored closely in the next couple of weeks. Now, this is interesting. If you just look at open interest that's on COMEX, you can see that there's particular contracts that's having a huge open positions. I think this was taken probably a couple of days back. You can see June contract specifically has about, I think, 400 to 500,000 open interest positions. That's huge. So it goes to show, again, COMEX, gold COMEX positions are deliverables. That means if you hold a long positions, you are actually subject to tender. So it tells you that generally, I think people are still expecting to, or rather they are still interested to take on the physical delivery for gold, or rather there's still a strong demand for the physical gold market, and that will probably be a sentiment that tells you that generally there's still demand for gold despite price at all-time high. Now, so I think, like I mentioned, net open interest position is something that we have to watch out closely. If as long as those positions are not declining drastically, especially during a uptrend market, that tells you generally the market is still healthy. Now, VIX is a barometer of fear, market fear. It's actually climbing to above 40 now, as I mentioned earlier. So it's reaching almost to pandemic levels. It does indicate to you that there's fear in the market. Market is again becoming very fearful. And these are the scenarios that usually will benefit gold prices. Now, this is an interesting chart. This is showing you the gold silver ratio. So normally the gold silver ratio usually trades between the range of 85 to 70 to 85 level. Anything that's above 85 is telling you that silver is way underpriced and gold is overpriced. So if you are a fan of silver as well, it's telling you that silver now has a big opportunity relatively to gold, because gold looks a bit more expensive while silver looks cheaper. So I think that's how you look at the ratio. But again, this ratio can obviously extend its range. It can go above not 100 or 110. It tells you just gold is generally favored more compared to silver, and therefore that explains why gold prices tends to do better than silver. So moving on to the second part, obviously looking at trading opportunities by looking at trends. No, so the key thing is that when you are looking at market trends, when the market is trending to a certain direction, always find positions for you to trade with the direction. So, example, if the markets are trending higher, or markets on an uptrend basis, find positions to long the market rather than finding reversal or trying to short the market when the market is clearly telling you that it's an uptrend market. So the key thing is that for trend trading, is always to identify the overall trend on the market. How you do that? You can obviously use moving averages, or you can just look at the chart visually. So looking at chart visually is looking at the highs and the lows. If the highs are making higher highs, and the lows are higher lows, that tells you the market is heading higher. It's generally an uptrend market. Vice versa, if the highs are getting lower, the lows are also getting lower, it's generally tell you a downtrend market. If the highs are pretty equal and the lows are also pretty balanced, or quite flat, it generally tells you the market has no trend. It's a sideways market. So in a sideways market, if you use trend trading strategy, it will not work. You tend to get a lot of whipsaws. So be mindful. Try to spot when markets are trending, and when markets trend, use trend trading tools as a way to navigate the market. Now, besides that, besides looking at charts visually to look at trends, or plotting moving averages to see where the trend on the market is, you can also use Heiken Ashi candles. Now, Heiken Ashi candles are some parts of candlesticks, but the key thing is that Heiken Ashi is in a way smoothing out the trend factor in a particular price movement. So, in a sense, it's helping you to identify trend in a clearer manner. And looking at Heiken Ashi may not be sufficient. If you pair that with moving average or even DMI as a trend tool, you probably get a good entry and exit signals. Now, I just want to share a little bit on ADX, which is a part of DMI, or Directional Movement Index Indicator, which I'm going to share later part. It's an important tool to tell you the strength of the trend. There's no point, once you identify the direction of the trend, it's also important for us to gauge the strength. There's no point to enter a trend when the strength of the trend is weakening. That means whether the trend is going to be exhaustive, or it's going to change in the direction. So you should be entering a trend in market when the strength of the trend just started. So how do we do that? It's just by looking at ADX. Last but not least, in any trading plan that you involve, you must have a way for you to get yourself stop out, just in case the market go against you. And the way to do that is just by looking at average true range or ATR levels to determine your profit, or even profit targets and your stop loss levels. So clearly, you just look at the chart for gold. Over since after the pandemic, you can see there's clearly an uptrend market. Most of the candles are holding above both the moving averages. The highs are getting higher, the lows are getting higher. It tells you generally gold is an uptrend market. So in the uptrend market, always find opportunity to long rather than short. It's never an easy business to try to time reversal in a particular market, especially when it's a trendy market. So be mindful. The overall gold market is still an uptrend market. Now, just want to depict to you the difference between Japan's candlesticks and Heiken Ashi. So this is basically a gold chart. Same time frame, same time period. The only difference is the way you look at the type of candles. So on the left is Japanese candlesticks, which is your common candlesticks as available on most platform. On the right is actually your Heiken Ashi. So Heiken Ashi, if you compare it, you can see that the color, the trend is decoded by the color of the bar. So as long as the market is heading, the market is showing you green candles, the body of candles are white, it's telling you this market is generally uptrend market. If the candles are red, generally the body of the candles are thick or white, it's just telling you that this is a downtrend market. Now, if the bodies of the candles are very small, almost like a doji, that generally tells you that the market has no trend, and in those period you shouldn't be using trend trading tool, and in fact you should use the range trading strategy or mean reversion. So if you incorporate Heiken Ashi, just for example here, with the moving average crossovers. So moving averages crossovers are simple. You just take one a shorter term and one is a longer term period, and you just pair them together and you combine that with Heiken Ashi, you pretty can get a good trading signals or entry signals. So what we have here is that the moment when the candles starts to turn green and the body of candle starts to get wider, and you pair that with bullish crossover and moving averages, so you can see that generally the market is poised to go higher. Vice versa, in this section here you can see that the candles are turning red, the body of the candles are getting wider, so it's telling you that this market has actually turned from into a bearish momentum, and there's a bearish crossover in the moving averages. So this is a good entry signals for you to take a short position. So you can pair moving averages to Heiken Ashi as a way to identify entries and exit signals. Now, I just want to introduce to you DMI, which is also one great trend trading tool. So DMI consists of 3 lines, but I'm just showing you the 2 lines first. The green one is what we call positive DI, the red one is minus DI. So the key thing to watch is that how to use DMI indicators or tool is there's crossover. So when the moment the positive DI, the green line is crossing above the minus DI, the red line is telling you that this market is poised to go higher. Now notice this, the intersection between the DMI green and red lines is quite similar when it comes to signaling for moving average crossovers as well. So in a sense that both these signals are giving quite overlapping signals. So you can either choose one. You can look at moving averages or you can look at DMI crossovers, because both of these tools are generally giving you quite similar signals. But what is important in DMI is actually the black line, which is what we call the ADX. Now ADX is important, it's based on the value. So ADX, anything that's below 25, which is a rule of thumb, it tells you generally the market has no trend. So in this example, you can look at this ADX, which is the black line here, is trading below 25 index point. So it's just telling you that during this period here, there's no trend at all. The moment it crosses above 25, it's telling you that the market is probably going to start trending. Regardless of direction, it could be uptrend, it could be downtrend, doesn't matter. But what's important is that once ADX crosses above 25, it's just telling you that the market probably going to start trending. So in this sense, once it crosses above 25, in this section here, the market is actually starting to go uptrend until when you reach, there's a peak in your ADX period or ADX line. It's just telling you that this uptrend is probably going to be exhaustive, or there's lack of strength in this uptrend momentum. So ADX is a very good measurement in terms of how strong is the trend. And important to highlight is that whenever there's below 25, the value of below 25 is just telling you the market is heading sideways. Just for example here, in this section here, the ADX majority of the time is trading below 25. This particular period here is actually a sideways market for the gold at this point in time. So example entry strategy, here's a very good entry strategy for a long position. Reason being is because you can start to see green Heiken Ashi bars with strong body or white bodies. So it's telling you that it's going to be a start of a bullish momentum. Moving average is also starting to cross over. There's a bullish crossover of moving averages. Same goes for your DMI crossovers. They're also showing you bullish crossovers as well. But notice the ADX line, which is very important. ADX is starting to cross above 25. It does indicate to you that this potentially bullish momentum will poised to go higher with strength. So as long as ADX is staying above 25 and it's going higher, it's telling you that this bullish momentum can stay, or rather this bullish momentum has a bit more legs to go. So next critical point is, once you establish the entry based on Heiken Ashi or based on moving average crossovers and also look at ADX, the next key thing is to position your target profit and your stop loss level. The key part is actually the stop loss level. So one way to do it is look at ATR. So at this particular time period, you're looking at the ATR value of 7.5, 7.5 points. So with that, you can probably set your risk to reward ratio. You can long at this particular point in time. If you look at one ATR as your risk, so if you're putting a 7.5 points below from your entry level, as a way to get yourself stop out in case the market go against you. And if you are targeting 2 ATR for your reward profit, you're looking at easily 15 points above once you entered as your target profit level. So that's how we use ATR as a way to measure your stop loss and your target profit level. It's important. But one key thing to take note about ATR is that when markets are very volatile, as what we're seeing right now, the ATR will start to rise. So importantly, if you use ATR to measure your stop loss, you have to acknowledge the fact that you have to account for bigger amount of loss of opportunity because your ATR level is rising. You can't set yourself too tight of an ATR because once the markets if it's too volatile, you can get stop out quite easily. So you have to maintain a sufficient range of the market by using the ATR value to make sure that you don't get stop out so easily. Okay. So this is just to illustrate the point on how to use ATR to set your risk and reward ratio. So for example, you just probably take a long entry at 29.42. Your ATR value is 7.5. Your risk to reward ratio is 1 to 2. So you're probably looking at to set a stop loss target of 1 ATR, and your target profit usually is 2 times your ATR. Again, risk to reward ratio is very personal strategy. Some traders will prefer a lower ATR, lower risk to reward. Some will prefer a higher risk to reward. Again, these are all very individual, but it depends on how comfortable you are when it comes to risk management. So now, going into gold forecast in terms of price, I think this has been revised. This was actually taken back in early February, but I think now majority of people are forecasting that gold can even go higher compared to what's the average forecast. So if you just take some of the big banks and you just tally their average, you should be looking at the average gold price for this year between 3,001 to 3,300 US dollar bounds. We are not too far away from that. This is average, so that there could be months where it can actually go above 3,003. So among that, I think Goldman is actually very bullish. Now, having said that, I always believe is that if you see a market that is always in one direction uptrend without any chance of retracement, generally that usually is not a healthy uptrend market. So I think the market is poised for retracement anytime. It's just that I think market is so uncertain right now across other major asset classes. I think that's what benefit gold prices. But I think once the trade tensions are settled down, or there's a ebb in terms of the flow of it, we should see gold prices tend to soften by then. Now, I just want to introduce to you, yeah, I've mentioned a lot on gold, and a lot of examples on gold are actually based on the US gold market. But I just also want to introduce to you that Malaysia also have, basically on the Bursa Malaysia Exchange, we have also the gold contract, the gold futures contract, which is the FGLD. Now, they actually revamped the FGLD contract to actually make it more relatable to the US gold market. So if you just look at the price that's quoted on the Malaysia gold futures, is actually very similar to COMEX gold prices. And this gold contract is what you call a Quanto contract. It's a 40 units per contract, and it's still based on US dollar, so it's making the comparison easier, and it's based on the price of USD for every one tick movements to a price fixed at 4 ringgit. So that's how this Quanto contract is being worked. So if you're interested to know more, if you want to gain exposure in the local space, I think this FGLD is a good place to start. We have a gold contract that's available for us to trade using ringgit margin by getting exposure in terms of US dollar gold price. So conclusion, I think gold prices is expected, with current uncertainty, is still expecting to hold above the 3,000 US dollar per troy ounce. Now, I still believe there should be a temporary correction. It's vital for uptrend market to at least see a bit of retracement before the next leg move up. Now, if 3,000 doesn't hold, I think very likely you could see prices to go back to at least 2,006. But I think the long-term future for gold, the prospect for gold is still very bright. I mentioned earlier, the factors that underpin such a bullish sentiment is mainly driven by central bank demand, and it's mainly driven by market uncertainty. And there's obviously the debate of whether the stand of how the US dollar prominence is going to be. So with so much uncertainty, I think gold tend to benefit in this section. So with this, I'm just going to end here. Just going to hand it over to Adam for any questions from the audience.
All right. So thanks, Mr. David. So I have multiple questions here in the question box. I'll read out to you, Mr. David. The
Sure.
first one, how does higher tariff lead to a possible global recession?
Okay, I think with countries retaliating, like you see in China, at first US was I think it was imposing almost close to 104% on China goods. That's heavy, so it's a heavy tax. But then I think China just retaliated and imposed almost, I think, 118 percent of tariff, which is also substantial. So with countries imposing on each other's goods, is definitely going to create demand destruction. So that tells you whether consumers are they going to shift to their own, are they going to consume within their own country. So I think with threats, with tariff that's being imposed, and with the threat of tariff with cross countries, generally that will mean lower demand in general, and that with lower demand in general, lower investments, that will create a whole cycle of chain of in the whole economy. That will bring slowdown in general. So that's how I see it, and that's how I view it. And that's how I see the impact of tariff in general. Uh, Generally, it's not good. We just hope that Trump will probably put a pause and start to negotiate. If not, if he's still insisting, I think that's going to create a lot of demand destruction, and that it will reverberate not only in U.S. economy, but I think across the world.
All right. I hope that's answer your question. Okay. So on the next one, next question is, what is the implication to gold price if the US dollars revalue the gold holding? I mean, the US, sorry.
That's a good question. I think if that really happens, gold shouldn't be at 3,000 now. Is you go to crazy levels because if you to revalue base the reserve based on the actual quantity, gold is not sufficient, and gold price will have to adjust substantially higher. I don't think uh, I won't say it's impossible, but I think the likelihood of it is still not high. But I think if that really happens, gold shouldn't be even at this level. It's just way too low.
Okay. So I'll move on to more technical questions. With more into the technical analysis lah. So
Sure.
one of the question, what are the settings that you use for their both EMA, as you mentioned just now in your slides?
Okay, so just to let you know the parameters. So in most cases, like the COMEX Gold, for example, normally I look at before the volatile periods. I usually look at an hour time frame. I always believe that anything that's below an hour, you can't see much. But nowadays, I think even 30 minutes, I think should be ideal, because markets are so volatile these days. So 30 minutes is ideal as a time frame. Now for the EMA parameters is that you have two different varying periods. One is a 9 period, and another is 20 period. So it gives you substantially enough on a short term and a medium term view on where the prices is.
Right. So another question about the on the technical as well. One of the attendees asking how to tell the ADX has peaked before it starts sloping down.
Okay, uh, that's a one good question. I think one way to look at when ADX peak is to look at the line itself. So once the line is getting flat, normally it's rising. ADX is rising. That generally tells you the trend is also rising. There's still strength in the trend. But once the line starts to peak or starts to go like flattish, that usually tells you that that particular trend is probably having not enough strength anymore or exhausted. So that's one way to look at it. You can't look at value. There's no point to say, oh, once you reach 60 or 70, that's usually where ADX peak. It's different because different product, different behavior. You can't just base on ADX as a value to determine whether it's peak. So look at the lines. When the lines or ADX line starts to reach its flattish level, that usually tells you that generally the market or the strength of the market is going to get weaker. So that's one way of judging it, rather than just looking at the value of ADX. Now, rule of thumb says that anything that's above 25 is showing you that strength in a trend. Anything below is generally is a range market. We still can stick to that, but if we pass the ADX of 25, just to determine when's the peak in ADX based on value is very difficult. So just judge the ADX line by the line itself, rather than just the value.
Okay, so one final question. I think this is going to be very interesting to you, David. So, since gold has become more valuable as they go by, is there any possibility gold being used as a gold-backed currency instead of the CBDC? I think this one is talking about the central bank digital currency.
Okay. I can't comment too much on the central bank digital currency. That's a whole new topic by itself. But what's interesting is that you can see over the past, at least the past 3 or 4 years, especially if you look at the chart I showed to you earlier, China as a central bank, they have been holding up a lot of gold, converting some of their assets, especially the US assets, whether it's US Treasury or US dollar, into gold. I think that tells you a lot. It tells you the role of gold, especially for central banks, is gaining more popular. So gold in general is getting more popular. And also, despite gone are those days where you start to see gold prices. Anything that is 1,000 is considered cheap. Now, gold is easily 3,000. So people are starting to be more aware. So I think going forward, gold as an asset class is going to gain more popular, uh, driven by also consumer demand. But I think the central banks is the main thing. Whether that will will come out a debate to say that, will central banks starts to move away from other asset classes and go into gold specifically? I don't think so. But I would say this: I think gold as a diversified asset for central banks, I think that's what they are doing. Eventually, whether that will replace other asset, that's hard to tell. But I also don't think that's the case. For now, I think central banks are starting to look at gold because it's a very good asset class to hold, as to diversify if they're holding too much of a paper assets, or too much of a certain currency. So I think that's where I'm looking at.
Okay, I think that's about it. But to close off in this seminar, I have one final question. Um, I think everyone would like to know, like, is there any room for the gold to rally in the near future, or is there room for the price to still going up?
Okay. If you ask my personal opinion is this, I still think that gold can still stay above 3,000. But like I mentioned, it takes a lot to stay at above 3,000. Mainly, there's need to be a strong demand. Like I mentioned, again, in the previous slide as well, consumers are also very sensitive. Central banks are also price sensitive. 3,000 to them is not cheap compared to last year. You still can get averagely about below 2,000, 4,500. So I believe that moving forward, once markets are a bit more stable, there's less risk in the market, you can start to see there's correction in the gold market. And I still think that you should see a healthy retracement in this uptrend to probably see gold prices below 3,000. But the next leg up, in the longer run, gold is still tend to be favored because there's still other uncertainty. And like I mentioned earlier, the trend for gold market in general is that people are starting to really look into gold, whether it's asset classes, whether it's something that they want to be holding it as part of their asset. I think that trend is starting to gain more prominence. So that will actually be something that will push gold prices even higher. Now, technically speaking, you should still see that as long as a major uptrend doesn't being challenged, gold market can still go even higher. As to the levels, if you just look at where the bank forecast is, 3001, 3003, means that easily gold can even reach 3005 for the next leg up. So I think that's an indication of where gold prices is. But I can't give anything that's further than that, because that's like almost like a crystal ball. I wish I know the answer. But really, I think that's how the way I view it. As long as the fundamentals are still there supporting the market, we still can see that the gold market is still an uptrend market for now.
All right, that was a stunning question and answer, Mr. David. Okay, so with that, for this today's seminar will be ended today. So I would like to thank everyone for attending this seminar. Uh, Feel free to visit our YouTube channel. This seminar will be recorded and will be posted and shortly by tomorrow. So if you have any questions or you have any inquiries, feel free to approach any of our dealers to your nearest branch or anyone that you know. So with that, I'd like to close this seminar. Good night, everyone, and happy Wednesday.
Thank you.